The Indian rupee has been in the headlines for all the wrong reasons. In September 2025, the rupee hit an all-time low of 88.3 against the dollar. Now put that in context, just 5 years ago it was trading at 73 rupees. Over the past decade, it has consistently lost ground, and this year it has become the worst performing currency in Asia. So why is the rupee collapsing? Why does it seem so much weaker than other emerging market currencies? And most importantly, what does this mean for you as an Indian saver and investor? Now, before we go ahead, if you like discussions around markets and macros, please make sure that you subscribe to the channel and join our Telegram group. The link is in the description. Let's break it down layer by layer. First, the big picture. Now, currencies reflect a country's economic health, trade balance, capital flows, and policy credibility. For India, the story is complex. On one hand, India is the world's fastest growing large economy, attracting record FDI inflows in recent years, with booming stock markets and a massive services sector. Now, on the other hand, the rupee has weakened steadily, just 20% in just 5 years. The truth is that the rupee is under pressure from both structural weaknesses and short term shocks, and together they have created the perfect storm. The first big factor has been tariffs. In mid 2025, the United States imposed steep tariffs on a range of Indian exports. Now, this was part of a broader wave of protectionism as the US sought to reshore supply chains and protect domestic industries. Why does this matter for the rupee? Because India's exports are a key source of dollar inflows. When tariffs hit, Indian exporters earn fewer dollars. At the same time, import bills, especially for oil, remain high. That widens the trade deficit, and a wider deficit means greater demand for dollars than supply. The result is downward pressure on the rupee. And compare this to countries like Taiwan or South Korea. When the US announced incentives for chip supply chains, these countries aligned quickly and secured exemptions. Their currencies, the Taiwanese dollar and the Korean won, appreciated 6 to 10% this year. India, by contrast, has been punished. So tariffs didn't cause the rupee's structural weakness, but they were accelerant. They turned the rupee from a laggard into the worst performer in Asia. The second factor is capital flows. India runs a current account deficit, usually 2 to 3% of GDP, and that means that the country imports more than it exports, and it relies on foreign capital to bridge the gap. Foreign investors in equity, debt, and FDI bring in those dollars. But in 2025, those flows have turned negative. In just a few sessions after the tariffs escalated, foreign portfolio investors pulled out around $2.4 billion from Indian equities. The logic is simple. Tariffs hit earnings, valuations look stretched, and the rupee itself is weakening, so dollar-based investors prefer to exit. At the same time, countries like Brazil and South Africa have benefited from capital inflows. Their currencies, the real and the rand, are actually up this year, buoyed by high commodity exports and very high real interest rates. Investors chasing yields prefer those markets. In other words, capital that might have gone into India is instead flowing to other emerging markets. That divergence has made the rupee even weaker. The third factor is India's structural vulnerabilities. Oil dependence. India imports nearly 85% of its crude needs, and every $10 rise in oil prices adds billions to the import bill. That's a chronic dollar demand India cannot escape. Second is inflation sensitivity. Food inflation, whether from onions, tomatoes, or cereals, quickly seeps into overall prices. To fight it, the RBI often has to raise rates, but that slows growth. It's a policy tightrope. And then there is policy unpredictability. While India has ambitious industrial schemes like PLI, the trade policy is often inward looking, with frequent tariff tweaks and import restrictions. That creates uncertainty for long term investors. By contrast, Asian peers like Singapore, Taiwan, and South Korea enjoy robust current account surpluses. They export high value goods like chips, precision machinery, high tech services, and they run trade surpluses. That structural strength anchors their currencies. India does not have that cushion. When shocks hit, like tariffs or capital outflows, the rupee has no structural defense. Now, some people argue India has nearly $650 billion in foreign exchange reserves. Shouldn't that stop the rupee from collapsing? The reality is that reserves help in smoothing of volatility, but they cannot reverse fundamental trends. The RBI has been active, intervening in the market, selling dollars and buying rupees, and that is why the rupee did not collapse from 88 straight to 90. But the RBI strategy is gradualism. It uses reserves to slow the move, not to peg the rupee at an artificial level. Why? Because defending an exact level will burn through the reserves very quickly. If traders believe that the rupee's fair value is weaker, they will keep testing that line. The RBI knows this, its job is to smooth and not to fight the tide. That is why, even with massive reserves, the rupee continues to drift weaker. Another debate is whether the rupee is artificially undervalued. Some analysts argue that if RBI stopped intervening, the rupee would fall to 90 or even 100 against the dollar. Now, there is some truth here. The RBI has historically leaned against rupee appreciation, which is buying dollars when inflows were strong to build reserves. That creates the perception of a currency kept weaker than its true level. But the counterpoint is India's fundamentals. A persistent current account deficit, high oil imports, and inflation risks all argue that the rupee's weakness is not artificial but natural. In fact, when you look at the RBI's real effective exchange rate or REER index, the rupee often appears fairly valued or even slightly overvalued against a basket of currencies. So the real story is this. The RBI does not keep the rupee artificially cheap, it keeps it artificially stable. The currency is allowed to weaken gradually and not collapse. That stability is the RBI's real policy tool. To understand the rupee better, let's compare it with China's currency, the renminbi or RMB. The RMB is far more controlled. Every day, the People's Bank of China sets a midpoint fix against the dollar, and the RMB is allowed to trade within a narrow band. Offshore trading is freer but still heavily influenced by policy. This is a managed peg system and not a free float system. And the implications are huge. For exporters, the RMB is more predictable. You can sign a global contract knowing that Beijing will not let the currency swing wildly. But for investors, it is less trusted. Capital controls means that you can't freely move money in and out. That is why the RMB, despite China's economic size, still is not a true global reserve currency. The rupee, by contrast, is a managed float. The RBI intervenes but does not set a daily peg. That makes it more volatile but also more open to global capital. So for India, this means higher foreign inflows in good times but sharper outflows in bad times. For investors, the rupee is less predictable than the RMB, but the system is more free. And now let's talk about what this means for you, the Indian retail investor. A weaker rupee means that imports cost more, which means that we are importing inflation. Oil, electronics, medicines, foreign education, overseas travel, everything priced in dollar gets more expensive. That filters into your daily budget, and even if your salary rises, your purchasing power in global terms falls. Export heavy companies benefit. IT services like Infosys or TCS, pharma majors like Sun Pharma, even chemical exporters earn in dollars, so when they convert it back to rupees, their revenues will increase. And import dependent companies, on the other hand, will suffer. Airlines, auto manufacturers, electronics assemblers, etc., they pay more for imported inputs, so the margins will shrink. Now, as an equity investor, rupee weakness means thinking sectorally. Tilt towards exporters and be cautious with importers. If the rupee weakens too much, the RBI may raise the rates to contain inflation or defend the currency. Now that hurts the bondholders in the short run as bond prices fall, but eventually helps savers through higher deposit rates. And here's the irony, when the rupee is collapsing, the best hedge is to own dollar assets. But in India, mutual funds cannot freely invest abroad anymore because the RBI has capped the $7 billion overseas limit. That window closed in 2022 and has not opened since. So unless you're using the LRS route, remitting dollars abroad yourself, you cannot easily diversify. So for the average investor, gold becomes the default hedge because it is dollar priced. And that is why gold in rupees often hits new highs when the INR weakens. Historically, the rupee has depreciated around 3 to 4% a year against the dollar. Over decades, this compounds. If you plan to send your child abroad in 10 years or retire with global travel goals, then you must factor this in. A falling rupee will silently eat into your future purchasing power. Here's the paradox. India is growing faster than almost any large economy, yet its currency is one of the weakest. How do we reconcile that? The answer lies in the structure. Growth in India is driven by domestic consumption and services, not exports. That means GDP can grow even if the trade deficit stays wide. But the trade deficit always puts pressure on the currency. So India can be a fast-growing economy with a weak rupee at the same time. The growth story is real, but it does not protect the currency the way export surpluses protect Korea or Taiwan. So what is the bottom line? The rupee is collapsing because of a combination of factors. Tariffs, capital outflows, structural vulnerabilities, and the RBI's choice to smooth volatility. Compared to China's RMB, the rupee is more volatile but more open, and for Indian investors, the implications are clear. A falling rupee will erode real wealth, make imports costly, and limit easy global diversification. Gold and select stocks act as hedges, but the system itself keeps you heavily exposed to rupee risk. So finally, when you see the rupee slipping past 88, don't just think of it as a chart. Think of it as an invisible tax on your savings. The rising cost of your petrol, the extra few lakhs you'll pay for your child's education abroad, and the quiet boost to exporters in your stock portfolio. The rupee's weakness is not a one off event, it's a structural story, one that every Indian investor needs to understand. If you found this breakdown useful, hit subscribe, join the Telegram group, and share this video with someone who's worried about the rupee. The more we understand these forces, the better we can protect our wealth.